Hi there, and welcome to our video on cash, covered puts, and covered calls. Today, we're going to take a deep dive into what these options trading strategies are and how they work, specifically for beginners. Let's start with a quick refresher on what options are. Options are financial contracts that grant the holder the ability to buy, call option, or sell, put option, an underlying asset, such as stocks, commodities, or currencies, at a predetermined price, strike price, within a specified time frame. Unlike stocks or bonds, options provide the right, but not the obligation to execute the trade. This flexibility makes options popular in managing risk, as they allow investors to protect their positions or hedge against potential losses. Additionally, options enable traders to speculate on the price movements of the underlying asset, potentially generating profits from market fluctuations. They are also utilized to enhance investment strategies, such as generating income through selling options or leveraging capital through options' inherent leverage. There are two types of options: calls and puts. 1. Call option. A call option is like having a secret power that lets you profit from rising stock prices. A call option is a powerful financial tool that gives investors the opportunity to ride the waves of potential profit in the stock market. When you buy a call option, you gain the right to purchase a specific stock at a predetermined price, known as the strike price, within a certain time frame. This means that if the stock's price skyrockets, you can scoop it up at a bargain and reap the rewards. 2. Put option. A put option is a thrilling financial tool that empowers investors to play the stock market in reverse and potentially profit from falling prices. When you purchase a put option, you gain the right to sell a specific stock at a predetermined price, called the strike price, within a certain time frame. This means that if the stock's price takes a nosedive, you can swoop in and sell it at a higher price than the market value, locking in your gains and defying the downward trend. Now let's talk about covered calls. A covered call is a clever options trading strategy that lets investors make money from stocks they already own. Imagine you own a stock and you decide to sell call options on that stock. When you do this, you receive an upfront payment called a premium. The beauty of it is that you get to keep this premium no matter what happens with the options. A covered call is an options trading strategy where an investor, who already owns a stock, sells call options on that stock. By selling the call options, the investor receives a premium upfront, which they keep regardless of whether the options are exercised. If the call option is exercised by the buyer, the investor is obligated to sell the stock at the agreed-upon price, known as the strike price. This strategy allows investors to generate income from their existing stock holdings while potentially limiting the upside potential if the stock price rises above the strike price. This strategy is a clever way to generate extra income from your existing stock holdings. Plus, it offers some protection if the stock price drops. However, it's important to keep in mind that it also limits your potential for making big gains if the stock price skyrockets above the strike price. In a nutshell, the covered call strategy is perfect for investors who want to make money from their stocks while potentially protecting themselves from downside risks. It's a smart approach if you're open to potentially selling your shares at a specific price and want to earn some extra income along the way. Example of covered call. Let's say you own 100 shares of ABC Company, which is currently trading at $50 per share. You sell a call option with a strike price of $55 and an expiration date of 1 month, which gives the buyer the right to buy your shares of ABC at $55 per share. In exchange for selling the call option, you receive a premium payment of $1 per share. If the price of ABC stays below $55 on expiration date, the buyer's option will expire worthless, and you keep the premium as profit. However, if the price of ABC rises above $55, the buyer will exercise their option, and you will be obligated to sell your shares of ABC at $55 per share. Since you already own the shares and bought them at a lower price, this is a profit for you. $500 for the difference in price. $5 hex 100 shares. And you still get to keep the premium of $100. $1 hex 100 shares. Payment as compensation for the risk you took on, which makes your total profit of $600. Now let's talk about cash-covered puts. A cash-covered put is a savvy financial strategy that lets investors potentially buy stocks they're interested in while getting paid upfront. Imagine you want to own a particular stock, so you decide to sell a put option on it. By doing this, you'll receive an upfront payment called a premium, which is yours to keep regardless of what happens with the option. Now, if the stock price drops below a certain price, called the strike price, the person who bought the put option has the right to exercise it. In this case, you're obliged to buy the stock at that strike price. So why is this strategy so appealing? Well, for one, you receive that upfront premium no matter what. Plus, if the stock price falls and the put option is exercised, you get to buy the stock at a lower price than its current market value. It's like getting a discount on something you already wanted to own. The cash-covered put strategy is all about seizing opportunities to buy stocks you're interested in while getting paid upfront. It's a win-win situation where you collect a premium, have the potential to buy stocks at a discount, and have the cash ready to make the purchase if needed. It's an attractive strategy for investors who want to potentially add stocks to their portfolio and get rewarded for it along the way. Example of cash-covered put. Let's say you're interested in buying shares of XYZ company, which is currently trading at $100 per share. You sell a put option with a strike price of $90, which gives the buyer the right to sell you shares of XYZ at $90 per share. In exchange for selling the put option, you receive a premium payment of $2 per share. If the price of XYZ stays above $90, the buyer's option will expire worthless, and you keep the premium as profit. However, if the price of XYZ falls below $90, the buyer will exercise their option, and you will be obligated to buy shares of XYZ at $90 per share. Since you were willing to buy shares of XYZ anyway, this is not a problem, and you still get to keep the premium payment as compensation for taking on the risk. In this scenario, your maximum profit is the premium you receive for selling the put option, which is $200, $2x 100 shares. Your break-even point is $88 per share, $90 to stock purchase price, $2 premium received, and your maximum loss is $4,400, $8,800 stock purchase price, $200 premium, in case the stock dropped down to $0. And that's a brief overview of cash-covered puts and covered calls. These strategies can be a great way for investors to generate income, hedge against market volatility, and potentially acquire stocks at a lower price. Of course, as with any investment strategy, there are risks involved, and it's important to do your research and consult with a financial advisor before implementing any options trading strategy. In conclusion, cash-covered puts and covered calls can be valuable tools for investors looking to generate income and manage risk in their portfolios. By selling options contracts, investors can potentially earn premium income and protect their holdings from market volatility. However, as with any investment strategy, it's important to do your research and consult with a financial advisor before making any decisions. We hope you found this video informative, and we encourage you to like, subscribe, and leave a comment below with any questions or feedback. Thank you for watching, and we look forward to bringing you more informative content in the future. And we'll see you in the next video.